Today we have an awesome interview for you, and it's not with an agent, so we're going to give you guys a little bit of a break, but it's a guy that's very closely connected to the real estate industry, uh, a bank originator from Movement Mortgage, Joe Meyer. Welcome to the show today.
Yeah, thank you. You as well. When we started this thing, it was just you and I. We didn't even have teams. It wasn't the Giambra team. It wasn't the Meyer team. It was literally just Nick and Joe starting at the bottom.
Scratching and clawing, begging people to hire us.
Pretty much. Yeah.
And here we are. So Joe, how much volume year to date?
Year to date, we've done 200 loans. We've hit about 40 million in production so far this year. So $40 million worth of mortgages.
40 million so far this year. That's one team from Rochester, New York, doing 40 million. If that's any indication on what the real estate market is like, that's a lot. So good stuff, man.
Yeah, I mean, here it's we have teams out in California where they do freaking 20 loans a year and they're doing 40 million, and you're jealous of them. But here to do that kind of volume in our tiny market with our sale prices, I'm pretty proud of it.
It's incredible. But I think about that sometimes too. If we were doing the number of transactions in Manhattan, like we'd be doing like 600, 700 million dollars a year. But anyways, we'll figure that out in P2 or P3.
Right?
All right, our main talking point here, we want to talk about what can buyers do to increase their purchasing power while buying in a competitive market.
Yeah. So, well, first of all, the first suggestion that I have to increase your purchasing power is buy now. Buy now because the inflation or the appreciation of the real estate market has been so tremendous over the last couple of years, and I don't know if you have that statistic for Buffalo, but it's been over 10%. And interest rates are extraordinarily low right now. We're still hovering right around 3% on the average, a little bit up or down depending on credit score and things like that. That buying now is going to give you the most bang for your buck, because if you wait a year, rates are going to be higher, prices are going to be higher. The same payment is going to get you less house. It's just simple math. So that's my number one suggestion. Get in the market, even if you're competitive and bidding over, you're still going to be in better shape than you are for in a year from now.
Joe,
Um,
a when someone bids $10,000 more on a house outside of like the taxes and the insurance, what is the average principal and interest payment increase by increasing your offer?
about $45 a month,
So
40 to
45
$45 a month,
so it costs you $45 more per month to borrow how much more?
10 grand,
All right, so for every
$1,000.
10 grand it's going to cost you $45 more. So if you're determining how high you should offer on this house, what you're saying is offer more, it's not that much more monthly, get into your house and start realizing the appreciation and all the other benefits that come with home ownership.
Yeah, absolutely. And I mean, how many houses did you sell 3 years ago with people that are moving now and are basically sitting on a gold mine of equity right now in their current homes, and they just bought 3 years ago?
And they haven't done anything and their houses are worth 60, 70, 80 grand more depending on the circumstance, which is just an incredible situation for most people to be in. To be able to make an extra 60 or $80,000 in 3 years, that was totally unexpected.
Yeah, and I think there was a statistic out there that the average net worth of a homeowner is somewhere around a $500,000, and the average net worth of a renter is about $2,000. So real estate ownership is a huge portion of net worth in this country.
So if you're increasing your offer by $10,000, your pre-approval amount you should still be within what the pre-approval letter is that you're offering to the seller.
Yeah, exactly. Um, Obviously, there's some little creativity that goes into that on our perspective. There's the black and white rule, right? But say somebody has a Capital One card with a $300 balance on it, and that monthly payment is $25. By paying off $300 on a Capital One card, that will equal the same monthly payment as $5,000 on a mortgage. So you see what I'm saying? So sometimes paying down a little bit on some of the debt to qualify for higher is usually the way to go, and the way we kind of lend people, especially if qualifications are tight. Um, and we also want to make sure that they're comfortable with their monthly payments, because you don't want to get somebody under contract and then be like, whoa, there's no way I can afford this either. So you got to make sure that people know kind of where they're going to be at and stuff like that.
So paying off a little bit of debt is like in other places of your life is something you could do to increase your pre-approval amount quickly.
Absolutely, 100%. We tell people to do it all the time. We have somebody right now. I mean, just picture if you have 5 credit cards with a total balance of $1,000, and each one is $25 a month. That's $125 a month that you're paying in minimum payments. Versus $125 a month in mortgage principal, you're talking $25,000 in principal balance to equal that same monthly amount.
So
it's tremendous. It's dramatic.
Yeah, you could pay off debt in other areas of your life to increase your pre-approval amount.
Yeah.
Awesome. That's a great tip from a mortgage expert. Joe, thinking about how things have been for the last like 4 or 5, 6 years, like you said, the markets have been on fire. From your perspective, how do you predict the future of the real estate market?
Well, everyone keeps saying the crash is coming. The crash isn't coming. It's not even close. It's not here. I mean, right now, the reason why the market is so hot is purely supply and demand. There's not any sort of artificial factor that's propping up the market. And if it tells you anything, that the worst economic period since 2008 with COVID and businesses being closed, and we essentially went into a recession because of COVID, and the real estate market is still exploding. I mean, just tells you that it's not an economic factor that's making this boom. It's just purely supply and demand. So this market's here to stay. All the analysts that I've seen is saying about 2 to 3 more years of this until we kind of can catch up and level ourselves out. Unless for some reason people just decide to start listing their homes, which has been the challenge, and inventory has been the challenge the last couple of years.
We'll see. There is definitely an inventory problem, and as you talked about, money is cheap. So it's cheap for people to upgrade their house. And, there's a lot of money within the markets right now because of stimulus money that was given to people and, programs that were out there to help. As now everyone's got money, money's cheap. There's not a lot of houses for sale, and houses are selling for a lot more money than what people are asking for because there's more buyers than sellers.
And construction costs are high, so you can't alleviate the problem by building more, because building costs just as much as being able to buy existing.
Speaking of construction, we have a first-time home buyer that's calling into the show right now. He actually has a couple questions for you, Joe, about where to get started in the loan process, and just some of the basics that go along with buying your first home. So we're going to give him a call right now and chat with him, and he has some questions for you. So let's just jump right into that.
Noah is joining us. He's on the line. Joe, to give you a quick background, Noah is one of Jolie's best friends. I've played hockey with Noah. I've seen Noah work. He works for Savarino Construction, which is a large general contracting firm. And then Joe is from Movement Mortgage. We started doing business with Joe about 6 years ago, and we love what we do. And Joe is like the mortgage version of us. If he doesn't know, he will find out, and his team's incredible. And here we are.
Yeah, so I'm looking at, trying to make my first home purchase, and just kind of a basic starting point. If I'm a first-time home buyer, kind of in your opinion, what kind of loans should I be looking for, keeping my eye open for, and what path should I be looking to go down?
Yeah, absolutely, Noah. So I'm not going to get too specific into details, obviously, to not broadcast your personal information over a podcast. But being a first-time home buyer, obviously, you got to kind of get a foundation of knowledge. And starting here with a mortgage lender is the best place, because we really let you know what you can afford or what you want to afford. We can give you your maximum qualifications based off of what we think you qualify for. Or if you're like, hey, Joe, listen, my lifestyle, I got 2 kids at home, I can't afford more than $1,200 a month. Well, we're going to put you on the right track to success, and listening to your needs and accommodating what you need in your life, because your ability's the best. So really telling me kind of what you want and letting me guide you there, we'll become a team, and we'll get you into something that you're happy with.
Sure. And I guess just stemming off of that, I guess a typical timeline for a loan, what does that look like? And are there like any obstacles that you see come up often?
Yeah, so I mean, from a mortgage perspective, Noah, for you, you work in construction. So like the first questions that I'm going to ask you, and you don't have to answer this live here, but like, do you work all year round in Western New York? Because construction is obviously has a seasonality aspect for a lot of stuff. So I'm going to want to gather that information, see if you get unemployment in the winter, and kind of really dig a lot deeper into your financials. But on top of that, it's kind of, there's a huge misconception out there that people think that if they don't have a 20% down payment that they can't buy a house. That's not true. We've had people put as little as 3% down payment down and get into a house. And sometimes I actually recommend doing that these days because of the way the market is, with rates being right around 3% plus or minus. Liquidating 401ks or liquidating investment accounts to put 20% down doesn't generally make sense, because the opportunity cost on your investment, you're going to make more on your investments than you are going to pay in interest on a mortgage. That's just the way the market has been. So usually I don't recommend that.
People do.
Sure. And I guess that kind of brings up one of the other questions I had with down payments. So those kind of just depend on the type of loan or type of mortgage, or how's that determined?
Yeah, so it's the type of loan, and it also depends on what you're looking for too. Are you looking for a single family, a multifamily? So there's a lot of factors that go into it. So like a single family first time home buyer is as little as 3%. If you want to go multifamily, I'm going to guide you down a little bit of a different direction. But yeah, so it's really just figuring out what you're looking for and what you want to accomplish.
So then, Noah, knowing that it probably makes more sense to have as much debt as possible because the interest rates are super low, Joe, from a single family and a multifamily perspective, from a conventional loan versus an FHA loan, what is the minimum down payment for Noah if he's looking to conventional loan, the lowest down payment on a 2, a 3, or a 4 unit?
Yeah, so for a multifamily conventional loan, you're looking at 15% down would be the minimum. Versus FHA is only 3.5%. So there's a big down payment difference between the two loan programs. And then we can get a little bit more involved with that too, Nick, when it comes to being competitive in this market. Obviously on the real estate side, the FHA loans, I don't want to say are frowned upon, but aren't generally as competitive with the lower down payments. So we want to put you in a competitive advantage.
And then Noah, the problem, like when you're in a competitive situation making bids on houses, if people are cash and conventional, they're going to hold more weight than an FHA loan because of how these loans are perceived by other people. So in a regular circumstance, if there's 10 offers and the highest offer is $200,000 and that's a cash deal, you're going to need to be at like 215, 220 to even have a chance of getting this house, and it needs to be in a certain condition that the seller's not concerned about the bank calling out issues. So you're always going to need to be the highest bidder on an FHA loan in a competitive situation. But Joe, if Noah's buying a double conventional loan, the minimum down payment is 15%?
Correct. It is now 15%. There used to be a 5% conventional option, but that went away this year, I think back in April. The agency who provided that program decided that they didn't want to do it anymore, so they switched it to 15%.
So it's 15% minimum down payment on a conventional owner-occupied 2, 3, or 4 unit.
Correct. That would be the minimum. Yep.
So then the alternative is to go FHA, which is 3.5% down.
Yes. Yep, exactly. And then from there, it's just figuring out how to be competitive with that, with those terms.
Okay, but if he buys a single family conventional, it's 5%. Is that income restricted?
3%, actually. Believe it or not, as a first-time home buyer, he can do 3% down plus closing costs, yeah.
Is that income restricted?
No. As a first-time home buyer, flat 3% across the board on a single family.
All right, so Noah, you buy a single family, it's 3% down. If you're doing FHA on any type of real estate, it's 3.5%. But you have to be really high on price if you're in a competitive situation being FHA. 15% down, owner-occupied for 2, 3, or 4.
Yep.
Now for FHA, is that something or you have to qualify for, or what does that kind of look like?
No, so anybody can qualify. Well, anybody can qualify for an FHA loan. There's not really restrictions in terms of like first-time home buyer or income or anything like that. The biggest difference between the two loan programs, Noah, is conventional is essentially like self-insured. That's where the whole term PMI comes from. With being self-insured and having no real government backing or government insurance on these things, they're generally geared more towards the more optimal buyer in terms of like higher credit scores or lower debt to incomes, things like that, things with strong compensating factors. Whereas the FHA loans are government insured, so having that government backing, HUD, which is the Department of Housing, has come in and said, like, listen, guys, if you go down to 580 credit scores, which we do, we will back these things to get more people homes. So it's a way for the government to support generally people, I don't want to say people with lesser means because that's not the right term, but less than optimal credit or less than optimal financial situations can still afford a home.
So if you could get approved for conventional, you're getting approved for an FHA. People take advantage of the FHA for minimum down payments because you can only have one FHA in your name at a time.
Exactly. Yep.
Do you have any other questions for us, Noah?
I think we touched on everything I had, kind of just a basic understanding of, everything and where to get started.
Noah, thanks for calling. I'll make sure you guys get in touch, and then any other questions, give us a call.
Yeah, I appreciate it.
All right, later, Noah.
All right, see you guys.
I don't do what I do without you guys being in the boots on the ground, really. In my opinion, is that you guys have the hard job. You guys are the ones that are out there every day running all over town, driving 30,000 miles a year to show people houses. And being knowledgeable with people showing these houses is kind of a feather in your guys' cap, not being what we call door openers. Anybody can be a door opener. It takes somebody with some knowledge and some experience to really kind of guide people on the biggest financial decision of your life. I mean, where else are you going to spend $300,000 or $200,000 in one shot?
Joe, what's the best way for people to get in touch with you?
My cell phone number is always the best way. Call or text is the best way, 585-727-4190. And then obviously we have our website, movement.com, and you can just look up my name through there. But generally just calling me or texting me is the fastest way.